Hello, everyone, and welcome back. As always, I am grateful and blessed that you've joined me today. I'm Ben, the Tax Pro, and today we're talking about one of the most misunderstood topics in taxation: how owning a legitimate business may help you reduce your taxable W-2 income under the tax law using legal regulations. I like to call this tax avoidance. Do you ever feel like every raise you receive when you're W-2 simply means that you're going to pay more in federal and state income taxes? I have a solution for you. What if I told you that many business owners legally pay significantly less tax than their own employees earning the same amount of money? Today, I'm going to walk you through two real-life examples of clients that I have, clients who have filed taxes with me, of clients based on real tax concepts that illustrate how legitimate business deductions and losses can reduce taxable W-2 income within the rules and with no fear of any issues with the IRS or the FTB in the state of California or any other taxing government entity in the rest of the country. Today's examples are simplified and are for educational purposes only. We're assuming all deductions are legitimate, which they were, properly documented, which they were, allowable under the tax law, which they were, and then none of the applicable limitation rules and threshold rules reduce the deductions in our examples. Let's get started. Example one, Mike's Weekend Fence Company. Meet Mike. Mike is single and earns $60,000 per year working for a local city government. He works a regular W-2 job, 9 to 5, 40 hours a week. Mike is in the effective 35% tax bracket and would have paid $22,000 in federal taxes and another $6,000 in California Franchise Tax Board taxes. So Mike pays almost half his money in taxes if you include state taxes, his car registration, the sales tax he pays on his sodas, and whatnot. Instead of spending every weekend at home, Mike then starts a legitimate fencing company. He advertises online, he builds a website, he obtains insurance, he gets a fictitious business license from the local county, he gets the required licenses from the state board for fencing. Every dollar he spends on capital investment, either for learning fees, expenses for equipment, tools, vehicles, is all a tax deduction. As long as it's used for his business, it can be deducted from his wages if used correctly to buy capital and equipment for his business and even reduce revenue for his business down to zero. He needs to open a separate business bank account. He needs to never commingle money. That's an accounting concept. You can't commingle money, that's an issue. Best practices, always, please. Keep accurate books and records, and please separate those records from your personal use. Now, Mike begins purchasing the equipment he genuinely needs to operate his business. Mike was going to buy a new truck anyway. He told me many years before his dream truck was a brand new Chevy Silverado, beautiful vehicle, costing $60,000 with all the fun stuff. And since he has a company car at his county job as his disposal for personal and business use, 100% of the truck will be used for business and is 100% deductible, including bonus depreciation, which means you may get to write off the whole truck off the first year. But you never want to deduct deductible expenses to exceed revenue in general, so we may want to save that depreciation on the vehicle MACRS, which is the Modified Accelerated Cost Recovery System, recommended 5-year period to maximize the lowest possible tax bracket for each of the next 5 years for Mike. So, in addition to that Chevy Silverado, Mike buys a trailer, Mike buys concrete mixers, post hole augers and diggers, generators, air compressors, nail guns, circular saws, laser levels, hand tools, ladders, safety equipment. He pays for commercial auto insurance for his Chevy Silverado to do his business. He also pays for general liability insurance. He also pays for website hosting with GoDaddy. He also pays for business software to keep track of his expenses and his revenue, and also a sales software system to contact his clients. He also has a business cell phone plan. He does online advertising, with Google advertising. He rents a storage yard for his truck and all his equipment when he needs to leave extra things there. He purchases lumber, concrete, fence posts, gates, hardware, and other materials used for client and customer jobs. If those items are used in the business, the tax law allows deductions or cost recovery for all qualifying business expenses and assets, subject to applicable rule, thresholds, and depending on how much you make, they can be exempt or not qualify. The truck and the equipment you purchased are over $100,000 worth of expenses. The depreciation on the work truck gets complicated with financing. So for the sake of the example and the real life example as well, Mike actually paid for the truck, which he was planning on buying anyway for personal reasons, even though he put it into use for his business. He paid cash in full for the truck. In this real life example, after Mike applied all the applicable tax laws and we had all our other stated assumptions, Mike's business has enough allowable deductions and deductible losses to reduce his taxable income from his original W-2 $60,000 from approximately 40%, which was his tax burden before, to 0%. And from $60,000, he paid about $28,000 in taxes. Now he's going to pay zero. So he saved $30,000 in federal taxes, and he saved another $6,000 in state taxes. The tax code is magical when you know how to use it. Again, this is a real life example with a real client who saved $30,000 in taxes, got a brand new truck, and started a new business. This illustration shows how using the tax code can lower your tax burden to zero and give you additional assets to produce money. Michael also has additional write-offs in years to come for depreciation on the work truck and all the equipment he purchased. So his taxes would have been paid instead of the government are paid to start his business based on the specific assumptions already stated. It's not a guarantee that every taxpayer will have the same result. Example number 2, Sarah's cleaning company. I have a client named Sarah. She works for Tesla here in the Bay Area. She makes good money. She earns $120,000 with bonuses on her W-2 yearly income. Sarah also purchased a home in the same year, and she owns a $500,000 home with a $500,000 mortgage. She got a USDA, no down payment loan, and pays about $5,000 a month with everything included. After legally deducting the mortgage interest and property tax from her income, her taxable income went from $120,000 down to $89,000. Sarah's tax bracket is in the 40% effective rate range at $120,000 and $89,000. She would have paid $24,000 in federal income tax and another $12,000 in state income tax, including local and state fees. She'd pay about half of that $89,000 in taxes, even after the deduction for her home mortgage. She and a friend started this commercial cleaning company, and they organized it as a partnership and an LLC, which I assisted them with, which is a pass-through entity. They leased commercial space. They hired some W-2 employees of themselves, which they employed to do the work. An LLC is a pass-through entity, and revenue did not exceed expenses in this case. After deducting revenue from income, they both still took a $35,000 loss for capital investment, and her portion of the LLC in the first year for both partners was $35,000 passed on to her 1040. This loss passes from the LLC over to the 1040 tax return of Sarah, so her $89,000 now turns into $35,000 in taxable income. Her new effective tax rate will be closer to $15,000 with a tax savings of over $20,000. And she owns a new business, and she's going to be super successful. So this business capital and investment she made were just taxes she would have paid the government. And instead, she has this wonderful business with a friend of hers and this LLC that's going to be wildly successful. They also purchased equipment for the cleaning services. They bought supplies. I apologize. They also have to carry workers' compensation insurance. They also had to purchase liability insurance. Just like Mike, they advertised with Google AdWords. They also had to purchase a variety of software to keep track of their employees, their work schedule, and as well as their expenses. They've also invested in growing their business in a variety of ways. Like many startup companies, they've invested heavily during the early years, in this case, the first year. And in this real life situation, with Sarah's share of the partnership, allowable deductions, deductible losses, she reduced her income from $120,000 down to $89,000 after deductions for home ownership, and then she deducted it from $89,000 down to roughly $45,000. So at $120,000, she'd have paid about $50,000 in taxes. At $89,000, she'd have paid about $45,000 in taxes. And under the actual apple to apples comparison, she went from $120,000 in taxable income down to $45,000 in taxable income. Her effective tax rate went from 40% and $50,000 down to roughly 6%, and I believe she paid about $7,500 in taxes altogether. So the point of this is, if you understand the rules, you can make a significant difference in your overall tax situation. Even if you're W-2'd, you do need to start a business, and it doesn't need to be for profit. If it's a nonprofit, different rules apply. If you're wondering whether starting or operating a business could benefit your tax situation if you're W-2, you don't need to guess anymore. The answer is yes. Every taxpayer is different, and the right strategy depends on your right individual facts and goals. We'd be honored to help. We do offer free consultations here at NPS Tax Solutions. Use the consultation link below to schedule a consultation with me, Ben the Tax Pro, or with another qualified tax professional here at NPS Tax Solutions. We'll review your specific situation, the free consultation, and discuss your tax strategies, tax avoidance strategies that are appropriate for you under the law. And once again, I'd like to thank you so much for watching. And my name is Ben the Tax Pro. And as always, we are grateful and blessed for every one of you who supports the channel. If you have not liked, subscribed, or shared, please hit that subscribe button and share a video today. If you found this video helpful, once again, please like, subscribe, and share it with someone who wants to better understand the tax code and stop giving their money to the government for no reason. I'm Ben the Tax Pro, and I will see you in the next video. One important note, I want you to know that I'm so grateful and blessed the channel's been growing so fast, and I want you to know I really appreciate it. So you're the ones who make this channel awesome. Keep coming back. I can't wait to see you again.